What is the most important price in the global economy? The price of oil? The price of semiconductors? The price of a Big Mac? More important than any of these is the price of money. For more than 3 decades, the price of money has been falling. Now, it's going up, and this will affect everyone's finances. From home prices and retirement fund values to bank account interest rates and tax payments. So, what exactly do we mean by the price of money? Well, if I borrow money from my bank, I pay a fee in the form of interest. Simply put, that interest rate is the price of the money I've borrowed. Central banks, like the Federal Reserve, set interest rates. But they can't freely choose any rates. Fundamental forces shape where the price of money settles. A lot depends on the balance between saving and investment in the economy. If workers stash away more of their paychecks, the supply of savings goes up and the price of money goes down. On the other hand, if businesses build more factories or governments borrow to pay for new roads or schools, there will be more demand for savings and the price will go up. That balance between saving and investment is the fundamental driver of the price of money. For the economics wonks, the level at which interest rates balance saving and investment while keeping inflation stable has another name, the natural rate of interest. To understand why this concept is so important, imagine what would happen if the Fed set borrowing costs well below the natural rate. With money too cheap, there would be too much investment and not enough saving, leading to an overheated economy and rising inflation. On the flip side, if the Fed sets borrowing costs above the natural rate, there'd be too much saving, not enough investment, and the economy would cool, causing unemployment. The natural rate is the price of money that balances investment and savings in a way that helps maintain maximum employment alongside a low rate of inflation. But this equilibrium is notoriously difficult to pin down. For over 30 years, the natural rate in the US fell. In 1980, adjusting for inflation, it was around 5% for 10-year bonds. But in recent years, it dropped below 2%. To find out why that happened and forecast where the natural rate might go from here, Bloomberg Economics built a model spanning half a century of data that captures the main drivers. This graph shows why the price of money has been dropping in the US, which is the dominant driver of global borrowing costs. The first reason is that economic growth has slowed since the 1980s. That's made investing in new factories and equipment less appealing, so people are more inclined to sit on their money. Secondly, demographics mattered. As the baby boomers started preparing for retirement from the 1980s on, they set more money aside, pushing down the natural rate. And then there's China. Its booming economy led to a surplus of cash, which it invested in US government bonds, or IOUs, lowering the cost of borrowing in the United States. The falling price of money had profound consequences. Low borrowing costs meant households were able to get cheaper mortgages. And the government was able to spend more on public services than it earned from taxes because interest rates were so low. Now, it looks as though all of that is changing. Demographics are shifting again. The baby boomer generation that helped push borrowing costs down is exiting the workforce, resulting in a smaller supply of savings. Changes in China's economy and fracturing relations between Washington, D.C. and Beijing mean the flow of saving across the Pacific into U.S. treasuries has come to an end, and U.S. government debt keeps rising. So So how much higher will the natural rate go? From the 1970s to the mid-2010s, the natural rate fell by about 3 percentage points. Bloomberg economics models shows that by the 2030s, it will recover about a third of that decline. Accounting for inflation, that means long-term interest rates could settle somewhere between 4.5 and 5%. But there are reasons to think the price of money could go up even more than that. Top of this list is the fight against climate change, which will require massive investment in sustainable energy. Bloomberg NEF estimates getting the world's energy network ready for net zero will cost $30 trillion. That's roughly 30% of last year's global GDP. If AI and other advanced technologies live up to the hype, that could lead to quicker productivity growth, encouraging more investment and pushing up borrowing rates. And if debt keeps rising as it has been, interest rates will drift higher still. All of these forces combined could push the 10-year yield up all the way to 6%. Even if borrowing costs don't rise quite that far, going from a world in which the price of money is falling to where it's rising will have major consequences for us all. Home prices and the stock market have both soared since the early 1980s, partly because falling interest rates meant borrowing to buy was cheap. With higher rates, the upward trajectory may stop, and some of those valuations could fall back to earth. Perhaps the biggest loser in this new high-rate regime will be the U.S. Treasury. Even if government debt doesn't rise any further as a share of the economy, the rise in rates will add 2% of GDP to Uncle Sam's annual debt payments by 2030. If that had been the case in 2022, the Treasury would have paid out an extra $500 billion to bondholders, 2/3 of the defense budget. Of course, some of the reasons for higher rates are positive, not negative. If the world is investing to combat climate change, most would see that as a good thing. And higher rates create winners as well as losers. Savers and investors piling into bonds will enjoy higher rates of return. The big picture, though, is that the world faces a wrenching transition. For 3 decades, interest rates were falling. And for those who started their careers after the global financial crisis, cheap credit may be all they've ever known. That is now changing. The price of money is going up. And everyone from homeowners to venture capitalists to the U.S. Treasury will need to get used to it.